Ever wondered what to look for in a stock before investing? The world of stock investing can seem like a labyrinth, filled with countless options and potential pitfalls. Selecting the right stocks requires not just a good understanding of the market, but also diligent research and careful consideration. The importance of wise stock selection cannot be overstated. In this video, you will gain insights into the key factors to consider before investing in a stock. First, understand the business in which you are investing. The key to smart investing lies not just in numbers, but in a thorough comprehension of the company's business model. Ask questions like, what does this company do? And how does it generate revenue? Delve into the products or services they offer, the problems they solve, and the value they bring to their customers. Knowing the company's competitive landscape is equally vital. It's essential to recognize who the company's competitors are and how the company differentiates itself from them. Is the company a leader in its industry, or is it a challenger trying to disrupt established norms? It's also beneficial to invest in industries you're familiar with. This familiarity allows you to make more informed decisions and anticipate industry trends. Remember, a good investment is one where you understand the business, so equip yourself with knowledge, and you'll be well on your way to making smart investment decisions. Second, delve into the company's financials. This may seem like a daunting task, but it's actually quite straightforward. Start by reviewing the revenue. This is the money a company brings in from its business operations. Is it growing consistently over the years? Next, look at earnings. These are the profits after all expenses are deducted. Are they also on an upward trajectory? Now let's talk about cash flow. This is the money that flows into and out of a business. A positive cash flow assures that a company can meet its obligations and invest in its future. Finally, examine the profit margins. This is the ratio of profits to revenues. Higher profit margins indicate more efficient operations. Remember, the importance of a company's financial health cannot be overstated. It is the foundation of long-term stability. It's like a tree. The stronger the roots, the higher it can grow. A financially healthy company is more likely to provide a good return on investment. Third, assess the company's valuation. This step is akin to shopping for a good bargain. You wouldn't buy a car or a house without considering its worth, would you? The same principle applies to stocks. Consider key metrics such as the price-to-earnings ratio, often referred to as the PE ratio. This metric gives you an idea of what you're paying for each dollar of a company's earnings. Similarly, the price-to-sales ratio, or PS ratio, tells you how much you're paying for each dollar of a company's sales. Another important metric is the dividend yield, which shows the company's dividend payment relative to its stock price. However, these numbers in isolation aren't much use. You need to compare them with other companies in the same industry to get a true sense of their value. It's like comparing apples to apples. An appropriately valued stock may offer a better chance for investment success. Remember, the goal is not to buy a cheap stock, but to buy a valuable stock cheaply. Investing in stocks doesn't have to be complex. Remember, it's all about understanding the company, its mission, its products, and the market it operates in. Then, delve into the financials. Look at revenue growth, profitability, debt levels, and cash flows. Lastly, assess the valuation. Is the stock overpriced or underpriced? Compare it to its peers. Use valuation ratios. These steps may seem daunting, but with practice, they become second nature. With these insights, you are better equipped to make smarter investment decisions in the stock market.